Hello, and welcome to the headline segment of Making Sense of Markets for the third quarter 2017. My name is Matthew Carvalho, Director of Investment Research here at Loring Ward, and I'll be your host for this segment. The headline segment is meant to put some perspective around topics that you may be seeing in the financial press and provide context for how those issues may impact a long-term investor. This quarter, stock markets around the world continued to rally, and the majority of headlines were quick to extrapolate that trend. Investors who at first were worried if the current bull market could continue to run were quickly reassured by CNBC that in fact this bull market could continue forever. Yahoo Finance shortly after mentioned that we are in a Goldilocks economy, not growing too fast or too slow, so that the bull market could continue. And later in the month we heard from Forbes and Advisor News that neither an interest rate hike, war, nor politics can stop this stock market steamroller. Yet, we know that bull markets do not last forever. Looking back at the past nearly 50 years of stock market performance, we observe that there are many cycles, both up and down, and that the length and magnitude of those trends appear to be random. Yet there are still some important takeaways from this chart. First, there is no preset level which mandates what a market will do next. In other words, there is no way to time when to get in or out of the market. We don't know whether the current bull market will last another decade or just another month. Secondly, whenever that downturn does occur, it's been fairly short in length, averaging less than a year and a half in the bear market since 1970. If you could weather that rough period, you were typically on the way back up a mere 2 years later. As you'll hear us discuss in the Making Sense of Markets performance deck, returns have been strong and steady throughout 2017, and volatility has all but disappeared from the market thus far this year. Yet it's always a good reminder that it's easy to downplay concerns about risk when markets have been going straight up for several years in a row. In this quarter's newsletter, Professor of Behavioral Finance and Loring Ward Investment Committee member Mayor Statman had the following quote: "A word of caution about reacting to strong market returns. Some investors may be tempted to take on a higher risk profile or portfolio than is warranted for them because good times can mistakenly lead them to believe that they may be able to handle more risk than they really can or should. Some investors can forget that markets don't always go up." And that's exactly what this chart illustrates. As markets rise, it's easy to continue investing. But then as markets fall, that feeling reverses, and you may feel nervous, frightened, or enticed to sell. And this can lead you to want to buy additional stocks when they're already risen, and to sell after they've fallen, which is a bad recipe for long-term returns. Echoing this idea is a quote from Nick Murray, an author in the financial industry with over 50 years of experience. He says, "The dominant determinant of long-term, real-life return is not investment performance, but investor behavior." So how can you avoid those pitfalls of emotional investing? In order to avoid those pitfalls, I truly believe that you need to see investing as a journey. I wanted to share a recent experience that I had which directly relates to this idea. I was in Colorado Springs last month with a coworker, John Scruggs, for a conference, and at the end of it we were able to squeeze in a hike. We planned to conquer one of Colorado's pristine 14ers, those mountains over 14,000 feet in elevation named Pikes Peak. The preparation had begun about a month before, finding the right shoes, ordering hiking poles on Amazon, reading about how to overcome possible altitude sickness. After all, I had never done a hike quite like this before. When the morning came, I had what I hoped was the right equipment: maps, plenty of water, and a plan for how we wanted to attack the mountain. We started early in the dark, charging through a few miles and about 1,500 feet of elevation before the sun came up. The miles and the elevation passed quickly, and there was a campsite about halfway through which we figured would be a good place to sit down and eat for a moment and assess our situation. How much water did we have left? How was the altitude impacting us? Were we getting any bad blisters on our feet? It was here that I started to see the correlations between this adventure and one's own course in financial planning. That preparation and review of equipment right before we left the car that morning, so similar to the investment review you did with your financial advisor when first starting that relationship. The timing of the early morning start and the quick pace to ensure that we had ample time to reach the top, just like goal setting with a portfolio. Are you saving enough given the time you have remaining to meet your financial goals? A reassessment halfway through to evaluate your progress towards your goals and determine any course corrections needed, just as true on a long hike as it is for a long investment horizon. We were in good shape and ahead of schedule, and because we were ahead of schedule, we've decided to slow down a bit and add in a few more breaks. This allowed us to enjoy the rapidly changing scenery around us and lowered the likelihood of an injury or excessive fatigue from pushing too hard at such a high altitude. Another investing analogy: when you find yourself ahead of where you expected to be, perhaps it's a good time to take some risk off the table. Well, we continued on and up onto the face of the mountain, and far off in the distance we could start to see the peak. The winds picked up dramatically, recording 60-mile-an-hour gusts, and we were suddenly completely exposed and found ourselves clinging to the side of the mountain during the faster gusts. Being ahead of schedule at that moment was critical. With bad conditions, we were happy to take it a bit slower. I imagine this is much like people feel in the years right before retirement, worried that changing conditions may impact those long-term plans. Still, several miles from the summit and encountering adverse conditions certainly put us at the bottom of that emotional roller coaster, but we continued on our route. About 20 switchbacks and a dizzying number of rock staircases later, we progressed foot by foot until we reached the top. And what a sight it was. Looking back down, it was amazing to be several thousand feet above those first mountain ranges visible from the original trailhead. Those obstacles that loomed large at first now appeared to be tiny ripples off in the distance. The key to help avoid the cycle of market emotions is to reevaluate your situation periodically to ensure that the course you've plotted is still the best solution and make changes as needed along the way. We can't predict markets, but we can take steps to ensure we stay on track through the good and the bad. So what are some additional steps that you can take to reduce the impact of markets' ups and downs on your long-term plan? Well, here's a partial list of topics that may be worth discussing during your next review meeting, such as making sure you have a rebalancing strategy in place, reviewing your risk tolerance, evaluating your progress towards your financial goals, assessing any changes to liquidity needs, and mentioning any special tax situations that your advisor should be aware of. Thinking through your entire financial situation can ensure that you will be well prepared for a variety of market conditions. Additional commentary can be found on the Making Sense of Markets portion of Loring Ward's YouTube channel.